Hello, in this video we'll be covering the basics of Forex. So let's start with a simple question. What is Forex? Forex is the market where one currency is traded for another. It is the largest market in the world. The New York Stock Exchange has the average daily traded volume of 22.4 billion US dollars. And this looks small when compared to the foreign exchange market, which has the average daily traded volume of 6.6 trillion US dollars. The majority of this is made up by large financial institutions such as Goldman Sachs. But the retail segment of the foreign exchange market is still 200 billion US dollars every single day. What is an exchange rate? An exchange rate is the relative price of two currencies from two different countries. If you've ever traveled to another country, you usually have to find a currency exchange booth at the airport and then exchange the money you have in your wallet into the currency of the country you're visiting. So now let's look at these 2 points. First, we have the exchange rate. This is an important one because the main key idea is that it's relative. So let's assume you're an American and you travel to Japan. You exchange $1 for 100 Japanese yen. Because the currency exchange rate is relative, the cost of a can of Coke, for example, in America would be $1, and in Japan it would be 100 Japanese yen. So you save no money from buying in either place, as it's the same, because the exchange rate means that it's the relative price of the two different currencies that's being exchanged. Very simple. So now let's look at when you travel to a different country. You go to Great Britain from America, you exchange all your dollars into pounds. You then carry on with your holiday, you don't spend any of your money, and then you come back to the airport. You exchange all your money back into US dollars. Then you realize they have made money. This is because of the change in the exchange rate. And these changes in the exchange rate is how you profit from Forex. When you start trading Forex, you'll have many currencies to choose from. But I would advise trading the 8 major currencies. And the 8 major currencies are the US dollar, the Japanese yen, the euro, the pound, the Swiss franc, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Some Forex traders have a different idea of what these major currencies are. They would consider the top 5 being major currencies, and they would call the bottom 3 commodity currencies. The commodity currencies being the Canadian dollar, the Australian dollar, the New Zealand dollar. However, for this example, and for your knowledge, I would say that all 8 are major currencies. Okay, so we have the US dollar, which is the currency used in the United States. Its nickname is the buck. However, it has other nicknames such as Benjis, Moolah, etc. But the buck will be the most commonly used one by Forex traders as their Forex lingo. Now we have the Japanese yen, the currency used in Japan, and its nickname is the yen. We have the euro. It's the currency used in 19 EU member states, including Germany, Spain, and France. Its nickname is the fiber. We have the pound. It's the currency used in the UK. Its nickname is the cable. We have the Swiss franc. It's the currency used in Switzerland. Its nickname is Swissy. Now we have the Canadian dollar. is a currency used in Canada, and its nickname is the loonie. Now we have the Australian dollar. It's a currency used in Australia. Its nickname is the Aussie. We have the New Zealand dollar. It's the currency used in New Zealand. Its nickname is the Kiwi. So these are the 8 major currencies. In general, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other countries' economies. And they're called major currencies because they're the most heavily traded currencies and represent some of the world's largest economies. Because they are the most heavily traded currencies, they will most likely have the lowest spreads, meaning the lowest transaction costs. So you spend less money for the opportunity to make more money. So this is very important, and I'll explain this in most likely a future video. When you trade in the Forex market, you buy or sell in currency pairs. The majors, the crosses, the exotics. The major currency pairs always include the US dollar. Cross-currency pairs do not include the US dollar. Crosses that involve any of the major currencies are also known as minors. Exotic currency pairs consist of one major currency and one currency from an emerging market. Liquidity is used to describe the level of activity in the financial market. In Forex, is based on the number of active traders buying and selling a specific currency pair and the volume being traded. The more frequently traded something is, the higher its liquidity. So now let's look. We have the major currency pairs, which always includes the US dollar. An example of this would be USD to JPY. As I said before, JPY stands for Japanese yen. And we have the cross-currency pairs, they do not include the US dollar. So an example of this would be Euro CHF, which is the euro to the Swiss franc. And then you can also have exotic currency pairs, and this could be the euro to the Brazilian real, or the pound to the zloty, which is the Polish currency. And yeah, there's many options to trade with. The liquidity is an important one to understand. Liquidity rises around certain events, the most important of which is the NFP, which is the non-farms payroll. This deserves a whole video to itself, as this is very important, as around this time, well, before and after, currencies can move 70, 80 pips, which is very, very high when it comes to Forex. And we will get onto that in a later point. Understanding this information will help you have a wider knowledge and understanding of the world and its effect on currencies. The 5 major emerging market economies are the BRICS: Brazil, Russia, India, Indonesia, China, and South Africa, all with growing economies. And we also have the Central and Eastern European countries. And it's an OECD term for countries that used to make up part of the Eastern Bloc, and as well as encompass other countries such as in the Baltic states, and as well as Southeast Europe. Next we have the G10 currencies, and these are the most heavily traded currencies. The majority are in the 8 major currencies that I stated previously. Next we have Scandinavia, which is the local term to cover Denmark, Norway, and Sweden. The currencies for the Scandinavian region is called the Scandies. Why is the US dollar so important? Well, let's look at the facts. The United States economy is the largest economy in the world. The US dollar is the reserve currency of the world. The United States has the largest and most liquid financial markets in the world. The United States has a stable political system. The United States is the world's sole military superpower. The US dollar is a medium exchange for many cross-border transactions. For example, oil is priced in US dollars, also called petrodollars. So if Mexico wants to buy oil from Saudi Arabia, it can only be bought with the US dollar. If Mexico doesn't have any dollars, it has to sell its pesos first and buy US dollars. Because people have to buy the US dollars, it always creates a stable demand for the dollar, which will permanently keep its price up, making its price fairly stable, which helps it be the reserve currency, and as you can see, it has a positive feedback. That's why in the news, whenever there's a scare, sometimes you hear scaremongering of people saying that of the removal of the petrodollar in favor of a maybe gold standard or the euro. And long term, it could have a negative effect for the dollar, but it is unlikely to happen due to the United States being the sole military superpower. And as the United States has a stable political system, it's unlikely for the economy to crumble. And yeah, it's just all positive for the United States. Much of Forex is speculation. In other words, most of the trading volume comes from traders that buy and sell based on the short-term price movements of currency pairs. The trading volume brought about by speculators is estimated to be worth more than 90%. The scale of the forex market means that liquidity, the amount of buying and selling volume happening at any given time, is extremely high. This allows you as retail investors, traders rather, to trade at any time during the week with little to no barriers, except of course the spread. And in recent years, many brokers are offering lower and lower lot size to allow more and more people to access this market. So then the price of the spread is going down because many other brokers have to compete against each other, and allowing smaller lot size allows more and more people to get into Forex. So I'm here to help you utilize this opportunity. Thank you for watching. Like and subscribe, and yeah, share if you want to help more people on their journey to become a profitable Forex trader. Yeah, if you want to ask me any questions, leave a comment down below or send me a text on Telegram or Instagram. I'll do my best to reply quickly. Yeah, thank you for watching.